Okay. So anyone, we're going to get started here. Anyone that's on Zoom, just know if throughout the meeting you have a question, just go ahead and unmute your mic and we will try to field the question. All right. We're going to get at it. It's right at 11. I want to be respectful of everyone's time. Kind of the goal is this can go an hour if it has to. We probably will get there. Probably leave the last 10 minutes or so up to questions. My name is Donavon DesMarais. I am an agent here at this office, Keller Williams Realty Elite. Have a very small team, just one other gentleman, Tom Hudak, on my team. Been doing real estate for 18 years and have been doing a lot more real estate investing the last 4 or 5 years. A lot of that first 14 years of my career was doing both sides of the traditional transaction, helping buyers, helping sellers, but increasingly I started to realize the upside benefits of helping investors. If you're a real estate agent, you probably get a lot of solicitations to your phone numbers that say, hi, I assume you do. Hi, I'm ABC company. We're looking for off-market properties to buy, improve, resell. I don't know, do many people get those or not? Yeah, I mean, it's a regular deal. There's a lot of lead generation companies that are constantly always soliciting us to say, hey, could you handle 2-3 more listings a month type of stuff. So just be wary of that stuff because they're really just, I default to that they're all scams until they prove that they're not type of deal. But nonetheless, I found that a big underserved sect of real estate was to serve investors. So today's training on the buy, improve, resell, otherwise known as flips, is kind of a double-edged sword of benefit. So one part of it is for you to be better educated on how to locate, analyze, and then act on an investment property for investor clientele. And then the other part of it is, should you aspire to do something other than just the traditional buy, sell in real estate, it gives you an opportunity to earn a living becoming a real estate investor yourself. And we'll talk a little bit about what that means and kind of the risks and how you set up your entities and stuff like that. But I want to encourage people to not get overwhelmed with thinking you have to completely 100% reinvent yourself to be able to become a real estate investor. There are ways to really hedge the risk and go in really kind of softly. This is one example. It's a common example. In our current Minnetonka School District market. It's what we're going to analyze is a house there. But don't get overwhelmed by the money and the cash piece, because it's the people in this world that figure out how to actualize those dollars and find those dollars or partner with people that have those dollars, put them into play that truly have huge changes to their lives and their lifestyle. My belief is that there's a lot of different ways to earn money in our industry, right? You can be a traditional buy-sell real estate agent. You can be a commercial real estate agent. You could be an agent focusing on industrial. You could be an agent focusing on new construction. You could be someone focusing on, you could be raising capital there's a term for it, I'm just blanking, to build apartments. There's people that go out and just spearhead raising capital, build apartments. There's just a lot of ways. You could be in mini storage. You could be in land development. Land development is a category I have really gone pretty deep into starting in about 2019. And for me and my family and my life, I've got 3 kids, 6, 4, and 2. I just felt that I can't continue and during the prime of my career, my first year of real estate, I sold $6 million in real estate my first year. I was grinding hard, helping buyers back in 2005. And then pretty much every year since then, I've kind of ranged from selling anywhere from 6 million, which was my lowest, was my first year, to as much as 35 million. Last year, my team, Tom and I, we sold 28 million. And of the majority of that, 22 million of it was my own. So know that when I'm talking up here, I'm not about shooting horns. I'm here just under free will, because I believe that there are other ways to make a really enriched living in this industry without having to put your head through the wall grinding after buyers and sellers. I just believe it. And unfortunately, a lot of the companies that we're with, wherever you are, they're really not huge advocates to endorsing their agents to become their own investors, because that doesn't lead to units. It doesn't lead to a ton of volume. However, my business, the land development business, simply put, is we go buy a piece of property, we carve it into 10 new lots, we build 10 new houses there, and I get paid to buy the land. Then I get paid commission selling all 10 of the builds on the backside. So I really eliminated any reliance I have on outside business outside of my own investments. That has been self-fulfilling for the last 3 to 4 years, and it's going to continue to be that way, period. Regardless of what the market does, regardless of what rates do, I'm going to continue doing that, because the imbalance for life is just irreplaceable. So today we're going to go into one category, which is commonly memorialized online. You see all the flip this house stuff, and if you have HGTV on your phones or your TVs at home, there's tons of stuff out there. We've been watching all for the last 10 years. It feels like maybe we've been seeing that online. And what I challenge is that I always default to not believing the numbers, right? I'm like, there's no way that they can do that for this cheap. And oftentimes those shows are rooted in different markets where we don't really know what the cost of labor and materials are there. All I do know is what I know, and that's this local market here. So today we're going to dive into one example of a property that's currently out there on the market right now. This property, I just did a search for single family, 1 levels in Minnetonka School District. And this property, for those of you that want to know just geographically about where it is just west of 494 and north of 7, over here, kind of in that corner exchange here. Really nice area, great proximity to 494, getting back to anything easterly, getting to the cities, or being able to jump on 494 and go north or south. The Minnetonka School District is a really good district for considering. I live in Minnetonka District. I live in Excelsior. It's a really strong district for people targeting resale improved properties that are sub 1 million. So you really can't start new construction in the Minnetonka District on call it a 3,000 to 5,000 square foot house. It really kind of starts more like in the low mid ones for the most part. There really isn't just a lot of developments going on, or tear downs and infill builds that are sub 1 million new construction. So what I believe and what I know is that there is, though, a population of buyers that has a very, very eager, active thirst to have homes that are sub 1 million that are in Minnetonka District and that are updated, right? And so if you think of like kind of grandma and grandpa's house that has been the same way for the last 30, 40, 50 years, when you're looking online, those are often like prime candidates. There's a lot of books that say, we look for the ugliest house in the best neighborhood. That's a pretty good theme. But we do have folks, because the supply of homes are still so sparse, that they're even remodeling remodeled houses. So when you're looking for houses, you may find something that's 5 to 8 years old, but it's already out of date in terms of how it's finished. And sometimes remodelers by default will just go to what I call reskinning a house. So they'll look at a house and say, without having to do major architectural changes to the room dimensions, layouts, or not putting any additions on, they will just kind of like strip down, the kitchen gets gutted, the bathrooms get gutted, the floors get peeled, and they're going to put new floors down. They're going to completely remodel the bathrooms, and you get a brand new kitchen, which includes all new cabinets, countertops, flooring, appliances, fixtures, poles, handles, etc. We are seeing some that are starting to just that are able to actually morph and transition a property into something totally different. So you can stay within the same body of the perimeter shell of the house, but for example, if a house has 3 bedrooms on the end of let's say it's a rectangular home, and on the end you've got 3 bedrooms that are there, and let's say you got a big owner suite at the end. What they'll do is they'll wind up comboing 2 bedrooms together, and yeah, you're going to lose the 3rd bed on the main level, but you're going to pick up an owner suite. And these renovators know that the biggest appeal for her often on the purchase of a resale is the kitchen and the owner suite. So if they can steal, a 12 by 12 or a 13 by 13 area from a 3rd bedroom, morph it in and transition it into now an owner suite that has a walk-in closet, they've got the freestanding tub, and they got the his and her or his and his, whatever it winds up being, hers and hers, I don't really care, but you get 2 sinks in it. That's a huge upwind, because what the plan is, then we're going to try to recapture that bedroom somewhere in the basement. So a lot of times, for example, this one as well, you'll see that the foundation of this house here, and I like to look for healthy foundations. To me, I like something that's at least 1,200 square feet or larger. If I start to get really excited when I'm looking at renovation prospects, when I see foundation sizes get like 1,700 to 2,300 square feet, because then I'm like, ooh, we've got potential here, because I can reconfigure rooms on the interior. If there wasn't a true owner's suite in the beginning, I can expand and make it larger. And then the other thing, like, I look for that really this kind of make properties like kind of slam dunk candidates, is that if you have something aside from just the standard 8-foot ceilings, you know, a lot of times these are these 1-level homes that don't have, you know, they're just pretty basic. But if you get into some areas like where there's a vaulted ceiling, like, see, for example, this one was, I call it partially updated. So they updated their granite countertops, but they didn't update like the cabinets and some other things. They put some new pulls on. Sometimes when you're looking at a candidate for renovating too, as you guys are looking online, is you really want to avoid houses where the staircase is like just slammed right in the middle of the house. Sometimes it can really impede your ability to like change configuring walls and stuff, because while we can move the staircase, it gets challenging. And the reality is, moving the staircase is pretty easy. It's probably sounds difficult in concept, but it's actually really easy. We just literally, we infill with trusses that the opening where the stairs are now, we cut out the stairs, pull it, and then we find an ideal place on the main level that also suits the layout in the basement to drop those stairs back in. And then we just re-engineer that opening to make sure that those trusses are still able to carry the weight. But nonetheless, this is just a property. What things that appealed to me is that it was in the mid-5s. It had a good sized foundation at 1,400 square feet. It's a 3-bed, 2-bath right now, and it only had in the basement. It has nothing finished. So to me, that's like a ding green lighter, because now I just get to go from wide open, clean slate and do whatever I want in the basement to be able to pick up. So in short, before I like dive into the numbers and stuff, I always have like 2 browsers going at the same time. Now, we're real estate agents. It's our job to know your local market. So if you've got an investor hunting in a market you're not familiar with, your job then is to get familiar with it, right? And it doesn't take but several hours on the computer and then several hours and a couple days out in the field. And what I mean out in the field is you want to be driving those neighborhoods. You want to be going and trying to preview or see those homes on your own time. So you're getting a feel for, oh, this is what 550 gets in Minnetonka District, in Shorewood, or in Minnetonka, or in Deep Haven, or in Greenwood, or wherever it is. So you want to get a feel for what 550 gets you here, because it's very different than what it might get you in Woodbury, right? And so once you've kind of acclimated yourself with your options here, then I always do a second browser that shows like where the comparables are. So what I do is, you know, I just right click and open a browser. As you see, I like browsers. I'm very comfortable with multiple browsers open at the same time. And so I just do a search. And how you do it, if you don't know how you do that, what I do is I go into the criteria, and I'm going to do coming soon, active, pending, sold. You can still check the temporarily not available for show. Some agents take their listings off the market during inspection periods so they don't rack up any days on market. And then I did Minnetonka District here. And then I kept it to 180 days. One thing to note, that if you get a weird crossover, like where you're going back into like dead of winter type of stuff, sometimes you might want to look back further, so you're getting like season for season comps when you're looking, instead of just snow comps versus like right flush green yard comps. I do feel there's an emotional upside appeal to make a property more likely to get its simple best price in terms when it's green out, because people see what's underneath the snow. And so it's not, it's minimal, but I would just say I like to, if you're not getting a good amount of like results, say I'm already getting 32, which is more than I want. So I didn't go refilter this back down, because I can hone this in a little bit, squeeze the foundation sizes into within maybe 400 square feet of each other. You can set some parameters, but in concept, we had, I did anything that's 850 plus. This is a really important one for you to fill in. So if you've got an investor in this example that you have in front of you, I'm going to say my investor wanted at least 100K at the table, right? And so that means that's cash, equity at the table, profit, pre-tax. Now, I don't go dive into how much they're going to get taxed on it. It's going to vary, but in terms of what they're getting and how the product performs, this is what we're looking at. So I went and did everything 850 plus. I could kind of hone this in and say, okay, what's really kind of fun? What's our competition really honing in at? And it's going to take it down to 7 results. And then you want to kind of peel into those and start to analyze like neighborhood, geographical location relative to local goods and services, relative to where it is to parks, how close it is to the lake. All these things you're trying to say, okay, because when you're doing the comp analysis or the market analysis, you want to try to establish a really good ARV. And after ARV means after repair value. Now, the rule of thumb that we always follow is that we always want to anticipate that our expenses are going to be higher and our resale is going to be lower. So you always want to be planning that way. So when I'm running these numbers with my investor and it's listed at, this thing's listed at 8, it's at 550 and it's been out for collectively 39 days, but 5 days at this price. You go jump up here, look at history to see how long that reduction's been out there. And it looks like they just reduced a few days ago. I know that might pop off. They adjusted it from, what were they at? I think they had came up, they canceled. So that was their collective days on market. So it's to the novice looker, it's a fresh new listing, but they tried to sell last year and were unable to do so. So I need to plan them to be paying all or near their asking price. I ran this analysis based on getting 550 because I did see the 39 days. And so if I were to rerun numbers, I may plan that instead of buying it for 820 or for 525 here, just plan that I'm going to pay 550. Now, many of you active agents know that 550 might not even be enough to get this property if it was a true, authentic, brand new listing and it was super clean, right? Because we are experiencing still multiple offers in this market, right? 7 out of 10, 8 out of 10 or more in certain areas, certain price points, still selling in multiples. So again, you need to burn that reality into your numbers. For conceptual purposes, we used an 8 or a 525 purchase price on this one. And then when you go back to this browser, so this second browser, you're looking at the market and trying to figure out where a really good like resale number is. Again, you always want to factor, you got to pay more for it and your expenses are going to be more and you're going to maybe carry it longer. And then that your resale is going to be lower. You do not want to be, for your investors, you need to stand behind the product that you're advocating they buy, right? So our job as a conduit to the process is that we might be lining them up with the general contractors that are going to be doing the work that they're going to interview and ultimately they select. A lot of that diligence can be done to reaffirm your forecasting of renovation costs during the inspection period. So if they're not getting multiple offers, I would try to target like a 10-day inspection period, and I would have your phone queued up and ready to call your best general contractor 1, 2, and 3. Now, one thing to say about general contractors, are they all geared to want to do renovation projects? Do all of them want to do renovation projects? No. I would venture to say that less than 10 to 15% even have any interest in taking on a renovation project because, number one, they don't pay the same as like an existing homeowner remodel does. Most general contractors privately over a glass of wine or a beer will tell you that they don't touch a project unless it's making 30 to 50% profit margin, period. So why would they go over here and do a renovation project at 17% like this contract's at, which is common for those that do it, is 17 to 22%, isn't uncommon. I've seen it lower and I've seen it higher. But there are, so when I say a general contractor has to be geared for it, that means they need to be able to work on a timeline. They're going to sign a contract up front. That's going to be a sworn construction contract. And then I call it a goods and services contract, where they're the things that we expect along the way. And then you have to decide with your investor, is the investor going to be actively involved in like making selections and choosing things throughout? Or are you as the agent going to be a partner in that with them? So we have investors that like do it 100% with the general contractor, and it's like great for me because I don't need to, I can give them some direction and say, hey, we should be going to kind of a gold focus in the kitchen. We should be doing the gold pulls and faucets, probably keep it really white on the countertops with maybe some strands of gold, or like some really not a busy, let's stick to the quartz on the countertops and kind of give some current trend information. But if you know you've got a client, your actual client is pretty in tune with that. If their house is that way or they've done renovations before, you can leave it to them. But don't leave it to them if you don't know that. Because I've had instances where agents have let the buyer said, no, the investor buyer said, no, we'll do that, we'll handle that. And then you don't circle back around until a couple of weeks before you're going to be taking final photos. And you want to just go bury your head in the sand because you're like instantly having regrets that you weren't involved, giving some influence and input on what selections are going down. Because, you know, I mean, everyone knows a person that's like Joe Handy, right? And they're like, oh yeah, I'll finish my own basement and I'm really handy with that stuff. And then you go look at it and you can see every single tape seam on the wall and you can see the router boxes around the outlets. You can see where the box cover doesn't cut. And it's like, oh my gosh, like you just caused more damage than you did good here. So again, I would just, a tip is saying, find out how affluent and how comfortable they are and how much time or interest they have in even doing that stuff. Because ultimately, if your general contractor is geared and doing a lot of remodels anyways, they have a good appetite and understanding of what's selling in a current market at a certain price point. Certain things are expected in a home that has an ARV coming in the upper 8s or 900 versus one that's going to be at 1.8 or 1.9, right? But when you're working within the shell of an existing home and you're just improving it on the inside, sometimes we're going to do a facelift on the outside and just, for example, this house had some stone, some old brick on the front that we would either replace. In the last couple we've done, we've just painted these a dark gray or a black and gotten like a black theme highlight and have some darker front exteriors and then do like kind of a gray around the outside. A lot can be done outside for a little if you've had the right general contractor. We also have investor buyers that are really handy, and the general contractor sometimes will allow them to do some things, especially if they're staying out of their way. So like outside paint work, or if it's outside deck work, or if it's landscape enhancements and things like that. If you've got a handy investor that wants to do some true sweat equity improvements, I would encourage them to get involved and see what that GC is comfortable letting them do. So that's kind of like how we kind of do the discovery of finding it, right? So you kind of need to get familiar with your markets, know exactly what your investor's looking for, and then try to figure out where are some of those markets that can fulfill an upside ARV that's going to garner enough profit there for your investor. As you saw, this one came in just over the 100 mark. And so we would be a green light deal for our investor all day on this opportunity. Questions on that came up as you were as I was talking? No.
Yeah. I was just looking through the numbers here, and maybe you're going to get into that in a second.
Yeah, we're absolutely going to go on the numbers next.
Okay.
Yep.
Then I'm good. Can you elaborate a little bit more on establishing your ARV? I mean, besides house.
Yeah. So, 18 years in, I've never formally done a full CMA. I've never used a tool for the CMA. I've never furnished someone a CMA. I just don't do it. I dive into the data and I have my own like summary overview that I give our clients that kind of gives all the high levels. Here's where our range is. Here's a subject comp that I think is really applicable. Here's a second one that's really applicable. And then we kind of do that if you've gone to a lot of KW trainings, it's kind of where you have your computer up with them and you have what you think are the 3 best comparables, and you showing them the pictures and you ask them, if your house wasn't your house and you could remove the emotion from it, do you think this house falls into one of 3 categories? Is your house superior, inferior, or very comparable to this property? And then you kind of see, you can get a real good feel right away if they're on the same page, if they truly can disconnect emotion from logic, right? Because we as realtors aren't using emotion at all. We're looking at, just from the very get-go, when I'm looking at ARVs, if I've got a comp that the subject's at 1,400 square foot of the foundation, and we've got something we perceive as a good comp that's got a foundation like 900, 1,000 square feet, just know the day those houses were built, that other house that's 40% larger was extensively more expensive to build, regardless of what was done on the inside, than the smaller house. So in a perfect world where we have a ton of comparables, I would have the foundation size. A lot of people don't even pay attention to the foundation size. It's important when you're representing investors because it's going to tell you exactly where we can get for total finished square footage. And I'll tell you what, the things that sell on resale is going to be how much can we push the total square footage to, how many beds and baths can we get, and then how are we going to dress that thing up when we reskin it and refinish the interior. So if I know I've got a 1,400 square foot foundation, I know at best fully finished every inch, mechanical, everything done, drywall, tape, finished. You got an epoxy floor in the mechanical room next to the furnace. I'm going to be 2,800. But if we want to back up a couple hundred square feet for storage or whatever, I'm probably going to max out in the 26s at best. So now when you're looking at your comps, you don't want to be going and using a 4,400 square foot or a 3,800 square foot comp, because you're not even the same planet. You're even the same place. Yeah.
Where are you finding contractors?
Well, so we usually lean hard on our social networks. So we'll go to LinkedIn and post the request. We'll go to Facebook, post the request. We'll go to Nextdoor, post the request. See who the community is going to endorse forward. You cross-examine them against Angie's List. The reviews I trust the most are the Angie List reviews. If they're a member on a service like Angie's List or Home Services Plus, I'm trusting those as being vetted. Those are legit jobs. There's a ton of data in there, even beyond the reviews. Job scope is in there, how long it took them, the contractor's contact info, everything. So I kind of let, beyond who I already know, I let the community kind of tell me, and then we cross vet them and interview them. You could do a post on Craigslist and have people respond. And I will put it in all bold caps saying, you need to be geared for renovation. I appreciate that you guys have a cousin Johnny and a cousin Billy. That's fine. If they're not geared for renovation, they're not doing it, respectfully, they're not going to be a fit, right? I'm not looking for someone to come remodel my house. I'm looking for someone that can work on a budget, that can work on a timeline, that is accountable, has integrity, and they're going to have a good product at the end. Tough to find, but they are out there. Believe it, they are. They are out there. So great question. Getting in the numbers, Dan, we'll go over this a little bit more. So the quick high level overview on this particular deal, for those of you online, I'm going to switch over to that. Online, is there any questions from anyone at home or at your office? I know I talk fast, but I can't turn it down. Okay, so here's the overview I have on the screen for those watching online, and all of you guys have the sheet here. So on this particular deal, I was factoring, again, this is a conceptual study here today, right? So some things may change or ebb a little bit, but conceptually, this is the deal. $525,000 purchase price on the quick overview. Closing costs with your bank or mortgage company is $15,000. We use Bridgewater Bank for a lot of our investments. They will fund acquisition price plus improvement costs up to a cap, usually of 75% LTV of like the end product. And so when you're doing your math and your analysis, the biggest thing your investor is going to want to know, or you, if you aspire to do your own investment deals, how much cash am I really going to have to come up with on like a given deal? Well, in this example, the cash needed to fund this deal A to Z is about $207,000. Now, here's where I challenge you guys to not listen to your little drunk monkeys and your demons saying, well, I don't have access to that. I don't have it in my bank account. That's an incredible amount of money. I don't deny that it is. Yet, if you're resourceful and between your familial networks and your friend networks and stuff like that, if you know people that have appetites to get involved in real estate, but they don't quite have the gumption or the fortitude to go do it themselves, this is a great gateway opportunity for your people that you know are successful in another business, another industry, to put some of their dollars to work. And what we do is we sign a contract with them and they become passive investors, and we will put together a pro forma kind of like this. And it says, here's the opportunity. We're looking to raise, let's say that you say you've got 50,000. So we're about 157 short. So I say, we're looking to raise $157,000 on this particular deal. Here's the summary. Here's how it performs. And I'm going to pay you X percentage of the profit for your dollars to be in play. And you lay out the runway, when you need the money, where the money's going to go, that it's not getting commingled into my own bank account. We're going to set up a new entity for this particular venture. That's 123 Venture Street. And the dollar is going to go into that bank account. You're going to have shared access to it. So you're going to see that those dollars are truly there, being used to fund the acquisition, pay for the closing costs, and then to be funding your payments along the way, your interest only payments while you're carrying the project and you're overseeing the project. Now, I always tell people when you're doing that, which is a great gateway to get into investing in your own deals, is if you're making 100,000 on this, you may say, hey, I'm going to give you 75% of the return, and I'm going to be putting in 25% of my own money. I'm going to give you 75% of the return. You as realtors are going to make the money on your acquisition commission when you're buying it, and then on the resale commission on the backside. And so it's a win-win for everyone. The goal is to try to find a win-win. And I would challenge you that the metrics you kind of want to be paying attention to is like, what's the current alternative investing platforms offering most people that have $157,000 sidelined or somewhere else? What's it doing or how it's performing for them? Mutual funds, for example, or if you're in like a mutual fund right now, it might only be performing at 6 to 8%. But if you're offering them an opportunity where they're making 15% to 18% of their money, it's really cheap for them to go and take those money from 401k for 6 months, put them into an active investment, have them, double the return in the same amount of time in something like this. And what I always tell them is that, hey, this is a collateralized investment, unlike a stock or day trading, whatever you're doing. If you lose it, you lose it. There's nothing collateralized. We have an asset here. The entity is going to be titled in our entity's name, and you're going to be protected with that. I'm just going to be spearheading and overseeing, really acting as the second general contractor on the project, because now your name and reputation is on the line. This is either a friend or a family member or someone you clearly know and trust to be able to approach them with this. But I can tell you right now, my investor network, which is literally friends and family, I could go out right now and get $500 million right now that I have that's sideline ready. I just need to put the right deal in front of them, and they would welcome me to bring every single deal to them. One of our most wealthy investors got over $400 million just recently selling their company, and they said that they don't want me to call any more banks. And so I'm doing a deal on Lake Minnetonka with them right now, and we're going to continue to do deals together. So trust your network, and you might be surprised, people, when you just are out at a barbecue or at a birthday party talking about real estate, I would challenge you to broaden your conversation beyond just a buy-sell conversation about the market, which is important, but you need to start learning or reading or becoming educated on talking at a high level about investing in real estate, because most people, if they're doing a daily grind, have an appetite to try to find a way to feel like they're getting a little bit of liberty or a little bit of control back to the future of their life, to be able to, if you can do a side project a year and you're working somewhere making 100 grand, but you can make $70,000 by just taking your money from a 401k that might be sitting with $500,000 there, and you're just going to put 157 of it to play for 6 months. And you're talking about the pros and cons. When I break it down, I tell them, here's the pros to the deal, here's the cons to the deal, here's some variables that could change. Remember, we always forecast high and we forecast low on the resale. And then if it still falls into an actionable range, then we're going to still probably do that deal. So there are ways, if you want to talk more about like, how do we get that money, or how's that look, or what's that contract look like, talk to me afterwards and I'll talk with you more about how to set that stuff up.
Would you suggest that you are presenting a 14 to 17% ROI on your investment?
Well, I'm not forecasting, right? I mean, if you look at the investment right now, I haven't even run the numbers on what 100 is over 9. I mean, but there's all kinds of metrics we can track: cash on cash return, internal rate of return, all these things. I didn't break these down or put, if someone really wants to look at cap rate or all that type of stuff, I'll give them those, but this is just a commoner layout. I know that the return is going to be way greater for them annualized over 6 months, because if I was giving them, let's say they're getting 75 against their $150, they're making a 50% return on their money, right? Approximately. Yeah, but not quite. Where we at? Let's call it 40% non-annualized. So then annualize it, and then you're at 80% and change. So we've done investments and are currently doing investments where we're making like cash on cash returns of like 470%. 470%. I have investors that want to buy apartments, and they tell me, if you can give me anything that's over a 20% cash on cash return, we'll buy 100% of them. So those opportunities exist, and those the opportunity I'm talking about, we bought retail on the MLS. So the stuff exists. So when you look at the breakdown, I did a 5-month hold. So I was planning for about a 3-month renovation from the time you close and take ownership. And then I kind of was banking that we're going to probably have a little bit of overspill. 3 months may go to 3.5. But then I was planning on the backside, once we relist and resell, that you're probably going to have about a 30 to 40 day like sale cycle window there for selling it. Now, there are some ways to like help you leverage the opportunity to be able to hog the resale on the property while it's mid-construction. And so you just have to be really mindful of the Mars rules with like, you've got your 21-day window on coming soon is your first teaser, but your real opportunity to get someone calling you and talking to you is to make sure that your general contractors and the job soups on site have their signage and stuff well presented in the front, and you're training them that if any neighbor stops or anyone stops here, you're giving them the listing agent's phone number. Because then at that time, you can go into engaging, qualifying, and seeing if they're a good fit for assisting them in purchasing the future resale. Now, there's a lot of psychology about, is it smart for any listing agent to advocate for an off-sale market in a market like we're in? Probably not. Probably not. I mean, if you're giving some sort of concession on your selling costs to your investor, maybe they can weigh that metric against like the auction philosophy of being publicly out there for sale. To me, if I could go head to head with the best of them, and I think most of the time the position is going to be your responsibility is to take care of your seller. That's the fiduciary, is your investor client. Plus, you're wanting to make sure that they're doing more and more deals. If you take care of them and you're doing what you say, saying what you're doing, and your property's performance you forecast, you just signed yourself up for an investor that might be do 2, 3, 4 of these a year. So forget about going and try to track down traditional emotional buyer or seller. Now you're constantly on the hunt. And then just kind of spread it out. It's not hard to get to 2 or 3 groups then that you're constantly always helping. And all of a sudden you become like an investor specialist, and they're always have an appetite to make money. And even as the market shift and the financial market shift, they still want to know what are the ways today based on the current financial markets and economic markets that we can still find success in real estate. So in this deal, I had that your total budget was about $200K. Of that, I have factored in that 17% of it is the general contractor fee burned in. So you're basically getting left with about $166 for the house and $34,000 for their fee. One of the biggest mistakes that people make is like going over budget. And I will say that when you are finding and discovering the general contractors that are geared for renovating, what you need to understand is the budget is not an arbitrary thing. This is an empirical thing that will hit, period. The only way that it will change is if the buyer or your client is making changes along the way. The budget for what we're doing will not exceed $200,000. It isn't like, oh, maybe it'll go to 210 or 220 or 230. We are signing a sworn construction statement up front that the general contractor is going to be working all their subs all the way through to make sure that what we want and what we need to be able to ascertain the ARV we need can happen. So if we get to a point where we're in a project and there's some surprise came up or we peeled into something and all of a sudden we got a new $10,000, $15,000 expense, guess what? Something on the trail end of priorities isn't going to get done on this flip. But our core leading priorities have to happen. Curb appeal, kitchens, baths, handles, poles, fixtures, paint, all those things, appliances, those still have to be primary leadings, non-negotiables, would never get cut. Your trailing stuff might be, hey, we got a bathroom downstairs, that's a 3/4 bath that was remodeled 12 years ago. It's so. We had 14,000 earmarked to tear it apart and dress it up and make it match kind of the upper level ones. And maybe we're going to have to scale that down now and instead just do like basically a facelift on that thing. We may do the handles, pulls, the fixtures, but we're going to try to get away with just the tile we have down. We're going to keep the vanity, we're going to repaint it, and we're going to try to just dress it up. Okay. And we're just going to bank that the market will still recognize that as an improvement, albeit it wasn't all the way down to the studs and built back out. When you do the breakdown of other things that you're carrying, one of the websites I use to try to figure out like what the biggest expense for me is going to be, and that's going to be your interest only payment you're paying to the bank. So I think tomorrow rates are probably going to bump again, but the interest only rate at Bridgewater Bank is 9% right now, and that's probably going to bump to like 9.25%. So I go to a website called bankrate.com, and I always do their interest only calculator on there to figure out what my IO payment is going to be. And then what you do to figure out your property taxes piece here and your insurance is the property taxes, you simply just go to the property, take its total annual tax, divide it by 12, and then times it by how long your project's going to be. So divide it by 12 and then times that monthly back by 5 to figure out what your total property tax amount is going to be. Your insurance, what that's going to be. You got to make sure you're talking pretty in depth with your insurance person is going to want to know exactly what's going on there too, because it's going to be a little bit more than your standard insurance coverage is going to be there because you have subcontractors coming in. Although the GC has their own workman's comp and all their insurances in play too. You just want to make sure you're never going to get sued, that your insurance company is there to protect anything that incidentals that happen. Utilities, you're just taking the annual utilities, dividing them again to get a monthly utility amount average, and then times it by the 5-month carry on the project. When you get to the high level numbers here, we're going up to your 525 on the purchase price, your 200 on renovation, and then your carry amount total, which is all these categories here, interest only, property taxes, insurance, utilities, is 25 grand. So you get a total number all in at 750,845. When the bank's trying to figure out how much, when you're trying to figure out how much your IO payment's going to be, you're doing the purchase price plus the renovation equals 725. And then usually their LTV, their loan to value ratio is 75%. So they're going to give you a loan and fund you up to 543. That's what your loan amount is going to be calculated on.
1 second, the one to the 15,000 closing cost, I see that in the roll down in the other calculations below.
What's that?
That 15,000.
So that might be, this might be that 15 should probably be in here. This should be 765. So good catch on that.
765.
So it looks like on this trailing amount 525 that this 15 might have been missing. So this 525 would be 540 plus 200 plus that. So it would be another plus 15 here.
Okay.
So notate that on your guys' sheets. If you guys all leave me your cards when you leave, I'll just re-email you this updated sheet so you don't need to like mark it up. But thanks for catching that. Going next to down payment. So that's the biggest thing people want to know is like how much cash is going to need to fund this whole thing start to finish. So you have 725 is the total amount. So purchase price plus the renovation equals 725. Is an 181 plus you had the carrying total, which was 25 here. So you get 207. How about call it 208 is about what your big number is that that's really what you're staring in the face, you guys. When you're looking at these investments, it's not like the 700 or the 800. It's like, what's the cost to carry and can we afford and find a way either ourselves privately or within our friends, family, or investor network to be able to fund it with a passive investor partner. Resale numbers are pretty easy and clear cut. You've got your ARV of 900. I did a sale price of 890. You go back to your numbers the day and I'm almost offsetting what I missed there in the 15 because 890 easily could become 910. I just was calling it at, let's say it's 900 and we quick take an 890. Again, I always like to factor low on the resale. So I had a commission here at 5%. So when I'm working with my investors, I'm usually telling them like, hey, I'm going to take a junior position on the commission split on the resale. We're going to pay out 2.7 on the co-broke to the buyer broker partners. And then I'm going to retain 2.3 before office splits. Okay. So then for title and closing fees, approximately $3,000. So 900 times 0.95% minus the 3,000 is your net number is 852. And then you're all in, we had it 750. You do the math, 852 minus the 750 is a 101 profit target pre-tax. It's better though, because we haven't factored in yet what your earnings are in commission. So we had 2 commission transactions that you're getting paid on, 2.7% on the 525 and 2.3% on the 900 equals a total of 34,000. So the total like deal opportunity for you is $136,000. So that's the overview. We're at about 15 minutes out. Hopefully high level that made sense. I want to open it up to like questions, things on your mind that came up as I've been talking that I can help try to answer. Yes.
You just straight buy me without the MLS?
Retail.
Oh, wait.
Yeah, in the last 5 years, I think we've only had like 1 or 2 off-market purchases that we've done. I constantly have them in front of me. Like right now, I've got like 3 land off-market ones that aren't quite fat enough for me, but our investor pools, we've formed up, you know, like we formed up a dock, like, you know, this is one that I have in Corcoran right now. That's an 825 purchase price, probably gonna be lower. It's 8, it's a 70-acre piece. And so getting that purchase price a little bit better is probably gonna be like a mid 150s return on it. And so my whole life is analyzing whether I'm in a spreadsheet or in a Word doc, like opportunities in a given week. I'm looking at 5 to 7 of them and just trying to decide which ones work best for my own companies first, and then which ones we want to bring then to our investor pools. And our investors always ask, like, well, how come you're cherry picking the best ones, this, that, and the other thing? I'm like, well, because it's my house. My house, it's my family, it's my livelihood. I'm going to be bringing you stuff. I bring you stuff. Do I not bring you stuff? I bring you stuff. But I can't do every single deal, even the best of ones, because I'm not wanting to scale. So there's going to be opportunities for something that just because I'm in something else that I'm having a cough up $500,000 to close on a $2 million land deal, that I can't do one that still has an upside with maybe $300,000, $400,000 fat on it. And I'm just going to give it to one of my best investors and say, this is what I'd be doing right now if I wasn't buying this other property in July. And but yeah, most of them are retail, short answer. Well, I'll come back to you.
What's your average profit?
What are land stuff? Normally I partner with one of my builders, and so that's a little bit more complex. So I always have like the land development investor piece up there, and we're always trying to make like 46% return on the raw numbers. So if we're investing $1 million, I want to be making at least 460,000 on the backside, and then we're usually splitting that. But then we're recapturing more earnings because, you know, if we're buying a 100-acre farm at $1 million and we're putting 500,000 into road and infrastructure, but creating 10 new lots, now I'm getting 10 new builds over there that we're investors over here on the land and the resale of the lots, but then we're building these houses over here and they're getting their 10% on their build rate. And then I charge a 4% fee on those deals, whether there's another broker or not. So if another agent comes in and we co-broker a new build, it's 6.7%. The builder has to burn into their numbers and factor into their pricing.
What about single family?
Single families like this, the biggest thing you want to pay attention to is like, okay, so if it's $100,000 here, how much money do you have to spend to make the 100, right? Because on this one, it's probably performing around what Dana done the math. So if you're about, for you and the investor, if you were funding it yourself, what's the 136 over your all-in number? 136 over 750, 845. We got a calculator?
So let's go to cash and cash.
I'm not, I'm not trying to do cash and cash. I'm just trying to see like performance health of the property. So the all-in numbers I'm in versus what I'm earning, 136 over 750 is my all-in number. So then I want to see what that percentage is there. So it should be, if you're 136, that what? Let's just run it quick. So we're going to be, and I'm saying if you're the sole investor on this one, so I'm taking into account the investment profit plus my earnings potential. So on this example, I'm going to do 136,030 divided by my all-in number of 750,845, and it's 18%. And so is that groundbreaking? Maybe not. Some investors may say, well, I don't want to be all the way in up at 750. Like, what deals or what markets in the Twin Cities allow me to make 100, but where my 750 is at 550? Right? So now I need to be buying something instead of in the low 5s. I need to be targeting stuff like in the mid 5s, but it gets exponentially more challenging as the price point goes down, right? So it's fewer and fewer opportunities like that as the price point goes down. And then there's more and more as you get into kind of this mid-level price points, like in the mid 5s, mid 7 acquisition. But you always have to be super conscious of like, your competition. And when you start to be where a remodeled home is going to be competing anywhere near an abundance of like new construction options, you just forget it and avoid it. Because people are going to default to a new constructed home, even if it's, in this case, $100,000, $200,000 more, is to me still too tight, too close. Because they're getting 10, 5, 2, 1 warranty. They're picking everything out themselves, start to finish. If they're going through the full build process, they get to pick their lot. They get to pick their timing versus just something that's getting put out to market that's done and turnkey ready. So I always try to stay away from, you know, anything new construction that's pinching me within a couple $100,000 on something like this.
Would you presenting your investor with cash on hand because maybe all attractive?
Yeah, again, I haven't done cap, I haven't done IRR, I haven't done cash on cash. Different deals are going to have different facets or number calculations that are going to be more appealing to them. Usually, a lot of my investors don't speak that language, and so they might be just Joe Buddy that's got a really successful couple businesses, and I know that they print money and they do really well, and they want to put some money into active play instead of passive with their financial advisors, and they're willing to put a couple $100,000 in play. I look at the pro forma. If I know they speak that language, then I'll put all those metrics up on the top. Otherwise, most of them just can interpret this and absorb this a little bit better. And this might not be enough for them just to say yes. You know, they go home, they got to think about it. I've got to still show them the property, or I show them my actual spreadsheet that shows, you know, a 50-line breakdown of all of the costs all the way through. But you're just trying to get an appetite, and you're always like telling them, you know, hey, you're the first ones I'm sitting down with on this. It's a brand new opportunity. I know that you have some interest in making some side money. Here's the opportunity, and here's how this would play. If it's not enough and the time isn't right, or you don't think another decision maker would agree right now based on whatever, totally respect it. I'm just wanted to make sure you knew about it first this time around on this particular project. And then you just plan to be talking to other people. I mean, I've got people in this office alone, and like agents that would throw 50, 100 at something right now on a deal, and they'd be passive. The cool thing about being a passive investor too is that they can 1031 exchange their dollars forward non-taxed. But you can't, because if you're actively involved finding the property, running the initial numbers, and being actively involved in the actual decision making of finishes and executing on that project, you're considered an active investor. So you get taxed regular income on that. You can't avoid it. Go ahead. Just here first.
So I was gonna ask, are there any type of property that you won't touch? But for instance, like I've been advised that, you know, anything built before 1940,
Yeah, it's a preference thing. I mean, like I have some people that were like born and raised in Old Town St. Paul and Minneapolis. They love those old late 1800, early 1900 homes, and those English Tudors or the Victorians or whatever. I've lived in them. My house right now is built in 1900. But they're just harder and harder to retrofit and kind of unwind the yarn ball and what's there, because you're dealing with usually, you know, what am I blanking on the type of walls, the not drywall walls, but they're plaster walls. So you get all the lathe and stuff behind there, and you're usually having, you know, asbestos wrapped pipes running the old boilers. So there's just some challenges that inherently don't exist when you're looking at properties that are like post-war era, you know, like 50s, 60s, 70s. And so I prefer by default on renovations that it's homes that are like 70s and newer. Because you start to get into some of the cool vaulting and stuff that kind of started to happen in the 70s. And I don't remember a ton of architects playing you know, in like pre-70s. To me, a lot of them I've seen, I've gone into 70s era homes and I'm like, oh my gosh, like this time capsule, I don't want to, I mean, can I just live here and like, and just keep it as it is? But yeah.
So 100,000 seems, sorry.
Go ahead.
100,000 seems like a lot. I mean, let me ask you this. So what's your average that you make roughly, and then what's your bottom to say, I'm not going to do this flip unless we get this?
Yeah. So there's some good rules of thumb out there. Like some of them are like, I think it's like a 20% rule or something like that, that whatever your return is against the all-in on the number, it needs to be at least 20% or more. If you Google it, there's a bunch like real estate investment ROI, like rule of thumbs or general best practices. There's 100, when you start to like, to me, I usually tell most people, if we're like sub 500, it's realistic that we can be, if we're sub 500 all in, that we can be doing something around like 50 on the return at the table for you. And it can probably find you some options, multiple options that are actionable. But when you start to go over 50, over 500K to make 50, the numbers just get watered down. And I always tell people, like, don't get allured by having this really big project that might be $1 million, or you're buying it at 900 and putting now 300 in, you're trying to resell it at $1.5 million and you're competing against new construction. It's like my confidence score on the ARV just goes way down. And it's like, I'd rather be doing 2 projects at 500 where I'm making 75 to 100 a piece. And I know that the market's there and they're just going to churn and churn and they're going to be gone immediately, versus pay attention to someone like the luxury in any given market is the top 10% of sales in any market. So if you're watching like luxury and you're excluding like lakes, in my opinion, especially like Lake Minnetonka and stuff like that, because there's really some big outliers out there. It's starting to slow down. They're taking longer to sell and the spreads are larger, like low 90s in some markets on like your like 1.5 to 2 upper $2 million homes that are out on acreage. It's either they pop immediately or they're starting to age. But yeah, I think it's realistic when you're talking to investors and learn some of those rules of thumb. But if someone's saying, oh, I want to buy no more than 250 and I want to make 50 and this, I'm like, no, like if you want to do that, like we're probably closer to 25, maybe 30,000 we can make happen. It's just, you're either going to give me a quest to go find you that stuff that's tangible and realistic or not. But I know enough to tell you, as you go down in price and you're still wanting a big ROI in the backside, the opportunities just go way down with it. You had a question.
Yeah.
Yeah. Yeah. So, I mean, I would say when you're doing these, you always have to be thinking about who's the profile of the buyer you're remodeling the house to serve. And I just feel like a really good starting place is like really strong school districts. So there's a number of places you can like start there. So I think our top districts at this part of the metro anyways, I mean, you'd have definitely Wayzata schools, Minnetonka, Orono schools. West Tonka actually is rating really high the last several years. And so, so I think that's one general metric to take it from like 30,000 foot view down to like 3,000 square foot view, or foot view where you're looking over a community. And then from there, you really want to kind of see where's the competition not crazy insane. A lot of investors are kind of going away from flipping because they think they're having to pay too much on the acquisition and that the financial markets is too volatile. I mean, I'd say that's more consistent right now, like the resale market and the consistency or the forecasting to be able to resell. I'd say what's changed is like we had costs for remodeling, like so the materials cost went way up and then they kind of softened back down. But now the cost of money has gone up so much that, today's interest only rate of 9 was 5 like a year ago. So that 4% differential times like a pretty complex large scope project can have a huge impact on your numbers. And so what happens then is they need to feel like they're getting better deals, or opportunities have to have a bigger upside for them to like warrant still going and expending the 5% interest only, because you're just paying an interest payment and not doing anything to that principal while that project's going down. So you make sure your GC is hitting on timelines and on budget, because you're just getting chewed up at the bank.
So when you work with investors and you said the title goes into the RLC or otherwise, do you present the investors with like a secure promissory note, or how do you present that to be to protect the money?
We set it up as a financial loan is how they're set up, is that they're giving a loan, basically acting as a second on the project.
Okay.
And then once that closes, it gets recorded behind the primary.
What if you bring multiple investors into the project?
I haven't had to bring multiples in. It gets way more complicated when, to me, like when you're starting out, if you have just a singular partner, passive investor that could get involved, it's way easier for a million reasons. We recently just did a project where it was a new investor partner, and we were kind of reluctant to do it because all these other things come into play about like, oh, what's their tax philosophy? What tax company do they use? Like the micromanaging or them questioning certain things. Like I got to a point where I'm just like, listen, you guys, you hired me as like the developer on this. I have a certain job description that I'm in control of doing. I'm not going to need to, I'm just because you're a majority owner in this LLC entity we set up, I'm not going to go I didn't set it up so I'm going to get your micro approval on every little $1,000, $2,000 expense. My high level number is 150,000 and I'm going to be probably 35% below it. So just sit back, call me whenever, and I'm going to give you the bi-weekly updates on progress, but I'm not going to do. So that starts to happen with now all of a sudden you have 3 investors that each put in 50, right? And you're almost at your 157. As long as it's conveyed to them that, hey, you're completely passive, here's the high level numbers, and I'll give the weekly reports. But as the spearhead to this project, there needs to be some trust in me that I'm doing this. You can still give them all view options on the bank account, and you can still give the bi-weekly updates. In terms of like leaning and stuff like that, yeah, you could lean them all separate, but I'm just going to create one entity that they're just having a promissory note in, and they're going to be leaning against as a second behind like Bridgewater Bank, for example. And so otherwise you can do 3 liens. So, but then who should be in order first, right? So if it's 3 at 50 and somebody's got to be recorded number 2, 3, and 4. So then it gets to be sticky. Like, oh, if things go bad, because you always have to be planning for worst case scenario. In order, first gets paid first, second gets paid second with what money's left, and then third, and then sometimes the fourth is shafted. So there needs to be a huge level of trust that the deal's gonna fly. I mean, a lot of our stuff is like so fat on the backside. Like I could have ebbs and flows and swings of $100 grand and I'd still be smiling ear to ear on the deal. I got one right now, the land deal I'm doing, like we're probably gonna make, we just added a component to it. We made all 9 lots are all gonna have like shared, like a boat easement to a landing and a shared dock. And we're gonna build the landing on the lake that doesn't have a public landing, but this will be a private landing for them. And it's going to take us from a 758, which if you guys went to my last class, I showed that spreadsheet up on there. It's going to take that thing up to like a 880, 890, because I'm going to slap probably $20,000-$30,000 premium on all those lots. And so, I mean, on that deal, I've got one partner and we're going to be in the 8s. And here's the best part of the 9 lots, we already have 3 sold and likely a 4th I'm going to have my bank out and that all sold. It's not going to be, I'm forecasting on like a 6-month hold on that, but it might be 2 months. So now all that IO money I was factoring and burning into my thing, which is it gets to be a big number. That's a 135 purchase price. So we're carrying $1 million in debt on that. So it's like $9,000 a month in interest only. For it to go from 2 months instead of 6 months is like a huge deal. Huge deal. So, and that's a retail deal. Sorry. Go ahead.
Do you ever buy?
No, I never got into it. I used to have like some interest in trying to learn about it. I know enough to be able to execute on it and do it. There's some people that just have that whole process mastered, and I applaud them for doing it. You can make really good money. To me, I ethically didn't want to get involved in it because I felt like somewhere in there someone was getting their situation being taken advantage of, and I just didn't want to be a cog and be perceived as this advantageous investor. Was my reason I never did it.
So you have a separate company, investment company?
Yeah, several.
On capital gains, right?
Yeah, so we get capital gains. We just literally take it. We just say, come get me. And to me, because a big part of what I'm doing is land development. As an active land developer, there's no, I can't 1031 exchange, and I'm deemed as an active developer. So I just get tax ordinary income, and rarely do we ever have stuff. Well, this one project will be 6 months. So that'll be, I'll get short term, I'll get hit, and that's going to be ordinary income on that.
So, ignorance on my part, why are investors, why can't they do it?
No, passive investors can. So if you're getting money or raising money from someone and your money is just active in a project, but you're passively involved in it, their money can 1031 exchange. Whoever's spearheading the actual project. So on the land development stuff, I mean, I'm putting the plat forward, I'm hiring the general contractor, I'm hiring the surveyors, I'm going to planning and zoning meetings, my name's on the applications, I'm actively doing the subdivision. Same thing on these remodels like this too, that if someone is, if you're actively involved in it and getting any percent of the return for like an investor pool that's involved, you're going to likely get exposed to ordinary short-term tax on it. So if you're taxed at 35% rate, you're going to get taxed on the development or the investment portion of profit on this deal. So the 36 will get, really that is your ordinary income. It's going to get probably exposed to the same formula. But when you're under LLCs and S corps and entities, you do pick up some tax benefits that you don't get if you were under a different type of entity. You just have to have a really good CPA firm that is helping guide you on that stuff. both from entity setup and then basically your tax planning through those entities.
So the 166, cost of remodel up there, what does that actually include? Is that any architectural fees, permits, with the city, all of that?
Well, it's all the requisite things, so permits, of course, but it's all the leading things that are most important that are gonna be able to garner me the ARV. So that's full, usually kitchen remodels, usually all the bathrooms are getting rehit. I'm not doing any remodels that doesn't involve us being able to like create an owner suite. I think it's just a insurance policy for your investment. If you can create a true owner suite that's appealing, you're gonna get well received by the buyer pool market and the buyer's agents. I always like to expand on square footage. And then so all the handles, pull, hardware, flooring. Usually I try to avoid windows where I can unless they're rotten out. So we'll do a repaint on the windows. Sometimes we put new hardware on the windows. Exteriors, you're just doing usually like a freshen up on the paint. But if there's old, like this house has some weird arcs and stuff on it that are just gross on the inside that just date it. Like these arcs, it's architecturally a part of their deal. So on this one, you'd have to decide if those arcs are going to stay in. There's another one there and another one there. I mean, it just dates it. A lot of people would just, if you're going to go with if a fireplace is this color too, and you're going to paint it like a dark gray, they'd go paint all these openings. This brick dark gray is the cheapest way. Otherwise, you're tearing it out and reframing those openings.
Factor in the time of year you're buying.
Seasonality. Yeah.
Really buying.
Yeah. So, I mean, most agents that have been around a while know, like, we haven't had a ton of like seasonality impacting values in our market. Historically, you always kind of accounted for seasonality. But the benefits of seasonality, the perceived benefits from like a novice to me are cons to someone experienced. So the perceived benefits to a novice would be like, oh, it's green, the yards are flowering and the trees are filled in. Yeah, that's an aesthetic positive. And most people, so what happens then is a lot of elective buyers, so not buyers that have to move, will wait till the spring. So when it gets pretty and all the people put their houses for sale, but we know supply and demand. If I'm thinking of going for sale, I'm going to be disadvantaged to wait until everything's green because that's when all my neighbors are coming on. Traditionally, now we know supply is just sparse. So when you say all my neighbors these days, it might be like one neighbor all season, all summer. Whereas back when we had better supply, it might be there's 10 houses going in within like a 3-mile radius that are a competitor to mine. But yeah, in general, things are just going to show better. Pictures are going to be better. It's going to pop. If you're doing aerials, they're almost moot in the winter. They're ugly looking at like brown trees with no leaves. They're beautiful in the summer if it's proximity to a park or a lake. It just shows the sell and the sizzles better. But there's more competition and I know it's going to be harder. As an agent, I would say if we're thinking we're going to go in the spring of any given year, we're maybe going to take advantage of doing professional photos that prior season when it's green. So then if we think it's going to start budding in April, we might go out in February, 2 months before the rest of the market's going to go for sale because they waited to put their photos online or waited for the photos to happen. And like right now, I mean, it felt like it was November yesterday. Pick outside. I mean, it feels like it's November today and it's May. So you can't really count on Mother Nature always having things popping and budding. But yeah, anything else? Yeah, appreciate it. Appreciate everybody coming and taking the time to listen in and everybody online just the same. Thank you.